In an era defined by tech optimism and sky-high valuations, WeWork emerged as a purported disruptor, promising to revolutionize the way we work. Yet, behind the sleek offices and community rhetoric lay a business model built on precarious foundations. What began as a charismatic vision for shared office spaces escalated into a financial spectacle, peaking at an astounding $47 billion valuation. But this valuation, inflated by venture capital frenzy, was ultimately a mirage. WeWork's journey from a darling of the startup world to bankruptcy is a masterclass in how ambition, unchecked investment, and fundamental misjudgment can lead to catastrophic collapse. At the heart of WeWork's early success and later downfall was its enigmatic co-founder, Adam Neumann. A figure of immense charisma and unorthodox leadership, Neumann crafted a compelling narrative around WeWork, not just an office provider, but a physical social network and a community company dedicated to elevating the world's consciousness. His infectious enthusiasm and grand pronouncements captivated investors and employees alike, fostering a cult-like culture that prioritized rapid expansion and an almost spiritual connection to the brand over traditional business metrics like profitability or sound governance. This personal brand became inseparable from the company's identity. From the outset, WeWork struggled with its identity. Was it a revolutionary tech company, leveraging data and community, or simply a sophisticated real estate landlord? The critical distinction lay in its business model. WeWork leased properties on long-term contracts, often for 10 to 15 years, then subdivided them and released them to members on flexible, short-term agreements. This inherent mismatch created immense financial risk. While WeWork branded itself with the agility of Silicon Valley, its core operations were inextricably tied to the capital-intensive and cyclical nature of commercial real estate. This fundamental contradiction would prove to be one of its gravest weaknesses. WeWork's explosive growth was fueled by an unprecedented influx of venture capital, most notably from SoftBank and its Vision Fund. Masayoshi Son, SoftBank's founder, saw WeWork as a transformative investment, pouring billions into the company with a mandate for hypergrowth at any cost. This capital enabled WeWork to expand at an astonishing pace, acquiring properties globally and entering new markets without prioritizing profitability. The sheer scale of SoftBank's investment, over $18.5 billion in total, demonstrated a belief in Neumann's vision that overshadowed traditional due diligence, pushing the company to expand well beyond sustainable limits and setting the stage for its eventual collapse. In January 2019, WeWork achieved its zenith, securing a valuation of $47 billion. This staggering figure placed it among the most valuable startups globally, reflecting a market captivated by its potential to disrupt the office sector. Investors justified this valuation by comparing WeWork to tech giants like Airbnb, rather than traditional real estate firms. The narrative was powerful, a platform, not just a landlord. However, beneath the surface, the company was hemorrhaging cash, recording massive losses even as its revenue grew. This peak valuation was less a reflection of sound financials and more a testament to the intoxicating power of perceived innovation and abundant capital. Driven by its massive cash injections, WeWork embarked on an aggressive global expansion strategy. The company rapidly opened hundreds of locations across dozens of countries, aiming to establish market dominance before competitors could catch up. While this expansion resulted in impressive growth in physical presence, it came at a significant cost. Many new locations were unprofitable, and the company's operational expenses soared. WeWork's strategy prioritized acquiring prime real estate and securing market share over sustainable, incremental growth. This grow-at-all-costs mentality was a core tenet of Neumann's vision but ultimately exacerbated the financial strain. Adam Neumann's leadership was characterized by a controversial pattern of self-enrichment and conflicts of interest. He personally owned properties that he then leased back to WeWork, collecting rent from the very company he led. In one notorious instance, he trademarked the term "we" and then sold the rights to WeWork for a reported $5.9 million. These dealings, alongside his supervoting shares that gave him outsized control, raised serious questions about corporate governance and the transparency of the company's financial operations. Such practices eroded investor trust and highlighted a dangerous blurring of lines between the founder's personal finances and the company's assets. Despite the outward appearance of success, numerous red flags were evident long before WeWork's implosion. Concerns about the company's valuation, its convoluted financials, and Adam Neumann's erratic behavior were routinely dismissed by investors, particularly SoftBank, who continued to pour money in. Analysts questioned the tech designation, pointing to the underlying real estate risks. The corporate governance structure, where Neumann held supervoting shares and controlled the board, offered little in the way of checks and balances. These warning signs were either overlooked in the pursuit of exponential growth or actively downplayed by those with a vested interest in the company's inflated valuation. The moment of truth arrived with WeWork's highly anticipated initial public offering, IPO, in late 2019. The company's S-1 filing, a mandatory disclosure document for public companies, laid bare the extent of its financial vulnerabilities and questionable governance practices. Investors and analysts were shocked by the sheer scale of WeWork's losses, $1.9 billion in 2018, and the revelation of Neumann's self-serving dealings. The S1 exposed the gap between the charismatic tech narrative and the stark reality of a loss-making real estate business. Public scrutiny intensified, leading to a dramatic drop in the projected IPO valuation and ultimately, the withdrawal of the offering altogether. WeWork's corporate governance was fundamentally flawed, operating more like a private fiefdom than a public-ready enterprise. Adam Neumann held disproportionate power through his supervoting shares, controlling a majority of the voting rights despite not owning a majority of the equity. The board of directors, often populated by those close to Neumann or SoftBank, failed to provide adequate independent oversight. This lack of robust governance allowed Neumann's questionable decisions and self-enrichment schemes to proceed unchecked, alienating potential public investors who demand transparency and accountability. The S-1 filing starkly highlighted these deficiencies, proving fatal for the IPO. With the IPO debt in WeWork facing a liquidity crisis, SoftBank, its largest investor, was forced to intervene. Masayoshi Son, who had championed Neumann, orchestrated a dramatic rescue package. This involved a bailout that valued WeWork at a mere $8 billion, a stunning collapse from its $47 billion peak. Crucially, part of the deal involved Adam Neumann stepping down as CEO and relinquishing control of the company. SoftBank effectively nationalized WeWork, installing new leadership and initiating a painful restructuring process to salvage its significant investment. The intervention marked the end of Neumann's reign and the beginning of a desperate fight for survival. SoftBank's rescue package in October 2019 was a complex lifeline designed to prevent WeWork's imminent collapse. It included $5 billion in new debt financing and a tender offer for up to $3 billion in existing shares. This injection of capital was critical for WeWork to meet its immediate financial obligations and continue operations. However, it came at a steep price. SoftBank's ownership stake increased significantly, and the company effectively took full control. While it staved off immediate bankruptcy, the rescue underlined the immense financial hole WeWork was in, forcing a re-evaluation of its entire business model and cost structure under new management. Following Adam Neumann's departure, WeWork embarked on a painful and protracted restructuring phase under new leadership. The focus shifted dramatically from hypergrowth to achieving profitability and financial discipline. This involved divesting non-core businesses, laying off thousands of employees, and renegotiating expensive leases. The company sought to streamline operations, optimize its existing portfolio, and rebuild trust with landlords and investors. However, the fundamental challenge of its long-term lease, short-term membership model remained, especially as the global landscape shifted dramatically, adding new pressures to the flexible office market. Despite significant efforts to right the ship, WeWork's core business model remained an unsolvable problem in a changing world. The pandemic, which forced widespread remote work, delivered a crushing blow to the flexible office industry, diminishing demand and increasing vacancies. Even as some workers returned, the market had fundamentally shifted towards hybrid models, making long-term commitments to physical office space less appealing. WeWork's legacy burden of expensive, inflexible leases, signed during its expansion frenzy, became an even heavier anchor, preventing it from adapting quickly enough to the new market realities. The initial tech narrative was now fully exposed as a fragile real estate play. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy protection in the United States. This declaration marked the final chapter in the spectacular fall of a company once valued at $47 billion. The filing allowed WeWork to terminate unprofitable leases, renegotiate contracts, and attempt a complete overhaul of its remaining operations. Despite the initial bailout and years of restructuring efforts, the cumulative debt, operational inefficiencies, and changing market dynamics proved insurmountable. The bankruptcy was not just a corporate failure, but a stark reminder of the perils of unchecked ambition and the immense financial destruction that can result from a deeply flawed business strategy. The collapse of WeWork left a trail of immense financial destruction. SoftBank alone lost billions, with its Vision Fund taking significant write-downs on its WeWork investment. Shareholders saw their equity vanish, while countless employees faced job losses and uncertainty. Landlords were left with vacant spaces and broken contracts, further destabilizing the commercial real estate market. The cost of WeWork's overvaluation extends beyond monetary figures. It eroded investor confidence in high-growth and profitable startups and served as a stark lesson about the dangers of prioritizing narrative and hype over fundamental financial health. The true human and economic ripple effects are still being felt. WeWork's downfall offers critical lessons for the venture capital industry. It highlighted the dangers of unchecked founder power, the insufficient due diligence performed on unicorn startups, and the intoxicating effect of a charismatic leader. The pursuit of aggressive growth at all costs, fueled by massive capital infusions, often neglected sustainable profitability and robust governance. Investors, particularly those managing large funds, are now under greater pressure to scrutinize business models more thoroughly, demand clearer paths to profitability, and implement stricter corporate governance safeguards. The WeWork saga underscores the need for a more disciplined approach to investing in early-stage, high-growth companies. Perhaps the most enduring lesson from WeWork is the danger of the tech company delusion. WeWork insisted it was a technology company, deserving of tech valuations, despite its core business being traditional real estate. This mislabeling allowed it to attract capital and command multiples far beyond those of its direct competitors in the co-working space, like IWG, formerly Regus. The company's software layer was minimal, and its innovation was incremental rather than revolutionary. WeWork exposed how easily traditional industries can be rebranded with a veneer of technology to exploit investor hype, often leading to unsustainable business models and ultimately, spectacular failures. Beyond the staggering financial figures, WeWork's collapse carries a significant human cost. Thousands of employees, drawn in by the promise of a vibrant, purpose-driven culture, faced sudden layoffs and career disruption. Many had invested their own time and energy into a company that ultimately failed them. Landlords, small businesses, and contractors who partnered with WeWork often bore the brunt of renegotiated leases and unpaid bills, creating a ripple effect of economic hardship. The dream of a global community became a nightmare for many, highlighting that business failures are rarely just about numbers, they impact real people and communities. The story of WeWork will long be remembered as a definitive cautionary tale in the annals of modern business. It encapsulates the intoxicating allure of charismatic founders, the perils of unchecked venture capital, and the fundamental risks of valuing narrative over financial reality. From its audacious vision to its ignominious bankruptcy, WeWork serves as a powerful reminder that even with billions in funding and boundless ambition, a flawed business model and poor governance can quickly unravel even the most hyped enterprises. Its legacy is a stark lesson for founders, investors, and the entire ecosystem of innovation. Hype is fleeting, but fundamentals endure.